tends to happen is that when businesses, particularly SMEs, get in some cash flow crisis, the first thing they do is they deprioritize payment of ATO liabilities, such as pay-as-you-go, GST and SGC. And the problem with that is that the longer they deprioritize it, the larger those liabilities become.
So welcome back to the Business Behind Your Business. We've just finished another hard year for business owners, particularly in Australia, but across the globe. It's been a hard year, building on a lot of the struggles we've had in the previous couple of years from COVID and economic and environmental conditions. And where are we at in terms of businesses? So a lot of them are under strain financially. We've gone through a number of years of hard conditions. Some businesses are at the point of, I guess, financial stress at the moment, contemplating whether they move forward or what are the options for them. But there is a number of things that any business owner needs to be aware of in terms of assessing their financial position. And we're seeing an increase in the number of insolvencies and liquidations and businesses closing. Why is that happening? What are some of the triggers and what are the things that we need to be aware of? And so I guess managing your business in the face of these additional burdens that are starting to really come through in terms of, customer expectations, customer availability and customer solvency. So welcome back to the microphone, Bruce Gleeson from Jones Partners Insolvency. Bruce is very passionate about small, medium businesses and not just helping them through the insolvency journey, but more importantly, helping them avoid the insolvency journey and helping them, I guess, stay afloat but I guess come back on the right footing, stronger and more profitable, which is what we really want. We don't want to see business failure. We want to see success. And Bruce has got some great insights into some of the traps that we can avoid and some of the key things that we need to be monitoring and aware of as we run our business. So Bruce, welcome back.
Paul, thank you. It's a pleasure to be back. And I hope that everybody, particularly SME owners, sort of find this podcast of assistance to them while they are out walking, running, whatever else as they're consuming this podcast. But you're right. I do really enjoy dealing with small businesses. Now that I guess term conjures up different things to different people because it can be quite, either broadly sort of viewed or narrowly viewed. But if we just sort of said for the purpose of this podcast this morning that small businesses or SME businesses are going to be used interchangeably, I think that will work. I think importantly, you touched on, some of the journey that SMEs have been on through COVID and as we've come out of COVID. And I think it's probably important just to, talk to that sort of time period for a few moments and bring us up to speed with where insolvency levels are at the moment and what we might see sort of in the near term, because that will become instructive as we unpack this morning what's going on in SME land, what are some of the things they should be particularly focused on, and relevantly, and as you'll hear me say a couple of times, the importance of getting good professional advice when they think that there's something that isn't quite going to plan. So I guess let's sort of go back to the beginning of COVID. What obviously happened then was the state and federal governments introduced a whole lot of temporary measures to make sure that as many businesses as were possible survived the period during COVID. And what's important just as a marker at that point is that just prior to COVID, the SME collectible debt due to the ATO was about $16.5 billion. That's billion. But importantly, what's happened because of those temporary measures during COVID, and principally where the ATO took a very hands-off approach to recovering SME debt, we've seen that SME collectible debt balloon out to $34 billion as at financial year ended 2024. So that increase is so significant. And of course, what's happened as a result of that is that we've seen a lot of activity principally over the financial years 2023 and 2024 by the ATO in relation to a recovery tool that it uses called a director penalty notice. And certainly the director penalty notice is something that all directors of SME companies need to really be aware of, because what it seeks to do is impose a personal liability against the director for pay-as-you-go tax, for unpaid superannuation guarantee amounts, and also for unpaid GST. And so it is important that, certainly in my experience, what tends to happen is that when businesses, particularly SMEs, get in some cash flow crisis, the first thing they do is they deprioritize payment of ATO liabilities, such as pay-as-you-go, GST and SGC. And the problem with that is that the longer they deprioritize it, the larger those liabilities become. And that sort of gives us some clue as to how that build-up occurred during COVID as well. But really what happened is that the ATO started to accelerate the recovery, or the clawback, if I can call it that, of the huge sort of increase in this SME collectible debt by issuing a lot of director penalty notices in 2023. It issued approximately 18,000 director penalty notices. And in FY24, it's issued approximately 25,000 director penalty notices. And certainly for the current financial year, so we're in FY25 as we record this, there's certainly still very significant numbers of director penalty notices being sent out to try and, as I said, claw back this SME collectible debt. So you can see against that what that has also done, and touching on your introduction, is that with those level of director penalty notices being issued, yes, we have seen a noticeable uptick in the level of corporate insolvencies. And certainly they're sitting, as at financial year 2024, at just over 10,000 for that year. Now, that does sort of get us back to some of the higher levels that we've seen over the past 20 years. So certainly that uptick is noticeable. But what's also important to think about is to look at the level of insolvencies as a measure against the number of registered companies. And what that shows us is that whilst the trend is definitely upwards there, that actual ratio is still sitting below long-term trends when we look over the past 20 years. But I think importantly, both ratios show that there is a noticeable uptick. And I think if we're building on what we've seen in terms of the level of tax debt there, and as you mentioned in the introduction, some of the stresses starting to show out in certain industries, I think we're going to see a sustained sort of increase in that level of insolvency activity. And so that's what makes this discussion important, particularly for SMEs. Because what we do know is that indeed probably almost 80% of insolvencies relate to SMEs. So, and when we look at the reasons for that, as we'll talk a little bit more this morning about, it's important then that SME owners and directors understand really some of the key things that they need to spend time on to try and give themselves the maximum possible chance of avoiding some period of insolvency, whether it be sort of on a temporary basis or something that actually requires them to go down a formal pathway.
And I think one of the temptations as we're listening to this conversation is to switch off and say, my business is not affected because I'm solvent. I pay all my taxes on time. I'm compliant. My cash flow is not great, but it's solid, and I'm not behind in anything. But what about your customers? What about the people you deal with? Because I've had a few unfortunate conversations with clients recently where a key customer or a large customer suddenly has gone into insolvency, and then that has put a strain on my clients' cash flow. And some of them are starting to go, well, hang on, can I get through this? Because how do I absorb this? I've already paid the cost of supplying to that customer, but I'm not getting paid now.
It's a great point. And, certainly if we look at larger corporate enterprises that are in existence, and some of the accounts receivable management tools they use, some of those corporates would have things like trade credit insurance and things like that. But, for a lot of the people in business that you and I typically deal with, the trade credit insurance option just is off the table because of the cost of it. And so, coming back to the example that you raised, there's a matter that sort of sticks in my mind from a long time ago, and it actually related to the Beechwood Homes external administration. And I remember there was a plumber that was significantly impacted by that external administration, who I had talked to. And the short point there is that he thought that he had a really, really great business. And indeed, he did, to the extent that it had grown in terms of the services that it was providing to Beechwood. But he had one key risk. The concentration risk was that Beechwood Homes basically constituted 90% of the company's turnover. So, yes, whilst he had a scenario where over the past 3 or 4 years, the business was growing at double digits, he was putting on more staff, he was getting more cars, all on finance contracts. But then when Beechwood went under, going to your point, he had a concentration risk where he had set no real sort of credit limits as to what he would allow that customer to get up to. And basically, as a result, there was those second and third order consequences that you see on large sort of insolvencies where his business ended up going into external administration as well because of that key concentration risk. And so one of the things that, as we'll get to this morning, is important for SMEs is that, yes, whilst things might be going along okay at any point in time, do you really understand, have you really actually planned for, certain things that might happen? And if they did, how would you manage through that? Is the business able to muscle through that sort of tougher period? So I think they're the things that hopefully we can help some SMEs with during this podcast.
Yeah, absolutely. So I think one of the key things that's come through, and why do so many small, medium businesses have tax debt, and I think you've touched on this already, but would just expand on it, is this deprioritizing tax debt. And in particular, we're looking at debt relating to employee taxes, employee superannuation, and of course goods and services. Because a lot of businesses are saying, well, hang on, because of COVID, I haven't made profit, so I don't have company tax or income tax. But it's this employee taxes and superannuation, which have sort of, I guess they've been either let slide or used as an alternative financing option.
Yeah, it's very right that, and the ATO talks a lot about this in the speeches that it gives when it's sort of trying to give SMEs in particular guidance about how to sort of deal with and manage tax debts. But it's historically been with SMEs that when they get in a tight spot, they tend to use the ATO taxes as a form of finance. And the issue is that apart from the personal liability that can come in certain circumstances in that scenario, it gets, they might do it for the first month because they are expecting a major customer receipt. But then when that doesn't come in and they have to do it for the second month and the third month, because then the customer disputes the actual payment, that's when it all starts to become quite significant to then sort of put back in order, because what they've got used to is in that deprioritization piece, well, the ATO has not been paid for 3 months. They actually haven't said anything to me about that, so I'll just keep that running. And then 3 months become 6 months, become 9 months. And then before you know it, that actual total is something then that the business has not got a lot of chance of successfully actually repaying in full. So I think that's how it sort of tends to happen. And I, having been in this kind of industry now for over 25 years, I see sometimes how it happens, but it's sort of moving to this point where it's beyond then actually being able to be repaid because it's been let go too long.
Yeah, yeah, and I think, and this will sort of tie into, I think, the other one of the other points that we want to talk about in detail is understanding the costs of what it is to run your business, and realizing that those taxes are actually part of the cost of engaging your employees. So maybe if we're not able to make the payments of the taxes, are we actually able to afford the cost of that resource, that employee? Or what else do we need to look at?
Yeah, look, and I think, there was a study sort of recently done by chartered accountants in relation to SMEs, and it found the 5 industries with the greatest number of SMEs, which are not surprising: cafes and restaurants, electrical services, consulting services, computer services, and residential building construction. So they are the 5 industries with the greatest number of SMEs. And if you said to me, well, what are the levels of insolvencies like across those industries? I'd say typically they're above average compared to some other industries. So in that context, and if we were to just, for example, take cafes and restaurants, well, certainly they really need to understand their costs, because, as we know, their 2 biggest costs are going to be inherently staff and rent. And to that extent, going to your point, Paul, when we're looking at staff, what needs to be looked at in terms of, well, what are my true costs of running this business, are the entirety of the staff costs. So it is adding superannuation, it is adding the pay-as-you-go in, it is adding workers' compensation insurance, it is adding, if applicable, payroll tax. It's building, the true costs of running that business, and then saying, well, against the backdrop of those costs, this is what I need to do each month to break even. And if I don't break even on that, then how many months can I continue that before either I make changes to the cost base? And bear in mind that you're not going to have too much ability to easily adjust the rent, because you may have committed to some 2, 3, or 5 year lease. So then your levers are around sort of staffing, maybe then looking at what you do to change your menu to try and generate some more revenue. But you don't have significant levers to pull there. So knowing what you actually need to break even, whether or not you're a cafe and restaurant or some other business, is really critical. And there's lots of businesses that you and I sort of talk about, Paul, where they start with all the good intentions, because the business owners are enthusiastic about the business. But what my sort of great concern is sometimes is that they still don't properly know what the costs of running that business are. And that means that then when they get into a period of crisis in that cafe and restaurant, because there's maybe not the take up in the services that they need, or there's some other issue, it starts to then sort of unravel reasonably sort of quickly. And that's what we're trying to help businesses avoid.
Mm. And I think, not understanding the costs is a big thing, because I think people come into business, and I've seen this a lot. They have an expectation that they only need to do a certain amount of revenue and they'll make a large profit, but they don't always include all of the costs. So they don't include the superannuation, they don't include the rental outgoings, they don't include the advertising costs or the cleaning costs, but when you actually understand what the costs of your business are, it gives you a much clearer picture about what your revenue needs to be. One, firstly, to cover all of those costs, and then two, to create a level of profit. And I did this exercise recently with a client where, looking at, well, these are the costs your business incurs before you make $1 of sales each month, and understanding that, and it was quite a sizable amount. And I said, okay, well, if your cost overheads are $250,000 a month, you have to make $250,000 of gross profit from your sales, not $250,000 of sales, 250,000 of gross profit. So after the cost of the inventory and the freight and the import duties, what's the cost? And we worked out that the level of sales to get the profit target that they were actually achieving, because they're looking at profit, they're not looking at break even, but the level of profit was almost double the amount of activity they were currently achieving. So the question then is, well, what costs can you reduce out of your overheads, or how are you going to have a strategy to increase your sales? And how likely is that?
And indeed, in a scenario like that, Paul, too, is actually understanding then this mismatch between the timing within which you're going to have to pay the liabilities for the provision of those goods or services versus when you're actually going to get the monies paid to you by that customer. And that's an important thing, not so much in the scenario of a cafe or restaurant, but the type of business that you were just talking about. Because if there's a mismatch between when that customer collection is going to occur versus when you're incurring the expenses, then as a business, you need to look at, well, how are we funding that working capital gap? Do we have enough short-term resources to meet that gap, or do we need to look at raising some funds from related parties, or do we need to look at, is a debt of finance facility for certain customers or for the entire customer book appropriate, albeit that then going back to the point that we just made, you would need to factor in the costs of the financing that type of facility provides. So, it is, we talk often and we hear, this cliche that cash is king. Cash is absolutely king. And knowing, what your break-even analysis looks like, knowing the mismatch between the timing of your expenses versus the timing of the customer payments, they are so critical in understanding then, what your business needs and how importantly for SMEs that, let's face it, tend to have a limited availability of management resources compared to larger corporates. Where do you spend your energy then?
Yeah, absolutely. And I think one of the key things is we talk about the timing, and I often refer to this as the cash flow cycle or the stock cycle. You might, particularly with an importer, you're paying for stock before it leaves the factory overseas, and it could be months before it arrives. So it might take 3 months for that stock to arrive after you've paid for it. You've then got to sell it. So it could take you another 3 months. And then if your terms are 30 days, you might get paid 30 days later. So that's 7 months after you've paid for the stock that you're then getting paid by your customer. So how can we shorten those cycles? And I think how we manage our accounts receivable is one thing, because you don't want, after you've made the sale, that blowing out to 60, 70, 90 days. But how do we manage that? And I think there's some useful advice you've got for people in terms of how they improve that management.
Yeah, and I think sort of I touched on one, but just to repeat it, knowing and setting some limits around customer percentages of your overall accounts receivable book. In that example I gave of Beechwood Homes, and then in that example you gave of you're importing and then selling and you have to wait, looking at the concentration of your accounts receivable ledger and setting some limits so that you don't have any one scenario that if it's late or if it's disputed, that it's actually not going to sink the business. And I know there's a temptation sometimes for business owners to say, oh, this client's really important to the business. And indeed it may, but if it's going to be able to sink or control the business, is that a really sort of good diversification strategy? I would argue that it's not. Now, I understand, and I think you and I deal with businesses at all different parts in their life cycle, and sometimes there might be a period where that does get outside of parameters that might otherwise be healthy. But it is about saying to be aware of that and know how you're going to bring that back in so that it doesn't have over time that ability to, as I said, control your business, because it says, I'm going to pay late or I'm going to dispute that. and it knows that it has leverage over you, so it can actually do that. So it is about sort of being live to those kinds of things. And I see that all too often in the construction industry with plumbers or electricians that are doing work with builders sort of in tier one or tier two sort of projects, and their contract administration is not strong enough. And so it actually means that it's having a profound effect on their cash flow, which then, as we've already touched on, is the reason why there tends to be this deprioritization of ATO liabilities.
Yeah. So you're sort of putting, I guess, putting all your eggs in one large basket, or the majority of your eggs. But if the basket drops, you end up with nothing. And I guess one of the other traps that I see, and we won't talk too much about this, is a business that has a high concentration of revenue from one customer. What we tend to find is that the profit margins on that one big customer tend to be lower than on other customers, because you're often financing the slow payment of that large customer, or you're doing extra. You might be doing an inefficient delivery just to satisfy that customer. You might be sending a half-empty truck to deliver, and you're doing it at the last minute, so you're paying overtime for your driver. So your cost of delivery have gone up, and when you actually analyse the profit on that transaction, you've lost money, because you're just so wanting to satisfy that big customer so they keep doing business with you.
And this comes back to some of the things that we've been talking about so far, that some business owners would say, oh, that customer is so important to the business. But when you actually go through that analysis and you break it down, you say, okay, but actually how much profit is it adding to the bottom line? And you say, not that much. The business owners sometimes are surprised, because in their own mind, they equate turnover to profit, and the two, as we've sort of talked about, are completely different. And so those kinds of conversations, do then sort of lend itself very much to saying, well, okay, you're doing some work with these customers over here. An analysis of that work and what you're charging for that shows that that's actually more profitable. Now, if you can get a little bit more of that, it might mean that you still do some work for that larger customer, but again, looking at the whole concentration risk of your accounts receivable ledger, it starts to become better managed. And I think that's sort of, things around sort of knowing the concentration risk of your accounts receivable ledger, knowing sort of what each of those main customers contribute towards the overall profitability of the business. And then you can start to set some other things around there, like, okay, does that mean that for certain customers you're going to set credit limits? So, and for those less profitable customers, are you going to set credit limits, and are you going to stay to those credit limits? Why do a lot of work for one customer if it's only marginally profitable? There seems to be a lot of risk in that if you're going to go down that path. And I think it sounds such an obvious thing to say, but it's so true. Don't apologize for having a firm and consistent accounts receivable policy. Sometimes SMEs are, shall I say, bullied into, oh, why are you asking me for payment from a larger customer? Well, that's just our policy. These are our terms and conditions of our, on how you trade with us. And I think it's actually being firm about what your T's and C's are around the accounts receivable policy, and not wavering from that. And again, this comes back to management of SMEs have limited time generally, and I would say that if we would ask some of the listeners today to take a couple of key points, it would be working with your professional advisor to know what your break-even points are, working with your professional advisor to look at your accounts receivable concentration risk, working with your professional advisor to come up with, if you haven't got them, some T's and C's for your accounts receivable policy, using automation as part of your accounts receivable policy. There's, as you know much better than me, Paul, there's some very good plugins to Xero and MYOB where you can automate your accounts receivable, where and not only just automate it, but actually get a lot better data on the management of your AR. And I think things like that, being firm and consistent about how you're running your AR is really important. It is the lifeblood of the business.
Mm. Just on that, I think there's another extension of that, because I think most people think in terms of automation, automatically sending out the invoice, sending out reminders. But you can actually go a step further there and use those tools available to actually go that next stage and say, right, okay, well, you've exceeded the payment terms. We've sent out and sending out the notifications that, okay, it's overdue. The next action will be debt collection. Making sure that that's part of your process and automated, but also then walking that through that process of saying, right, okay, they have ignored your warnings. You do need to take legal action and to recover that debt, and you need to do it in this time frame, because the longer you leave it, the less likely you're going to be able to recover it. So I think we think of debt collection as, we've run out of money, we need to chase people.
Mm.
But really our process needs to be firm, like you said, but also systemized and consistent.
Yeah, any good credit manager will talk to you about the importance of having a process and following that process, because it's the process that then means that you're dealing with each sort of customer in a consistent way, and you're giving yourself as the business that's owed the money the best possible chance of recovering it. As I said in that example of the Beechwood Homes administration, the plumber, that plumber had let that account get out to 180 days plus, and they were still doing lots of work for Beechwood Homes in circumstances where it represented 90% of the customer base. So it had so many eggs all in that one basket. As soon as basically there was going to be a hiccup there, it was going to have a profound impact on that business, which it did. And so it is, around that accounts receivable management that is so critical to be properly planned and properly done for SMEs, particularly where, as we said, there's a mismatch between when they're incurring the expenses and when they're expecting the revenue. You just can't, where there is that mismatch and therefore that working capital gap, you can't then have that blow out because you don't have an effective accounts receivable management system.
Yeah. So very, very key. So cash key, understanding your costs, understanding your obligations, and knowing what your expenses are, and understanding, I guess, what your profit margin needs to be, factoring in all of those prices. And I think there's one other aspect that we mentioned previously when we were sort of preparing for this, but we haven't raised it yet, and that is the separation of the business bank account and your personal bank account.
Yeah, look, we certainly see that there is the temptation at times that the business owners of SME enterprises tend to treat the company account as their personal account. And so it may be that the company pays for a whole variety of personal expenses, groceries, alcohol, recreation, restaurants, all of those things. And really, what tends to happen is that gets out of control. And that then becomes a circumstance where, when we look at the profitability of the business and indeed, what it can generate, it can't the profitability is not at a level where it's sustaining that incurrence of all of the personal or private expenses. And really, whilst some business owners say, oh, well, that effectively is part of my remuneration package, the point is that it's actually not being properly managed and properly looked at in terms of the profitability of the business. So it can also be the thing that then crimps the cash flow as well. And it then has the further impact that on some form of external administration, such as a liquidation of the company, that's a loan account that then the liquidator can then ask to be repaid. So, certainly that whole sort of treating the company as your personal account, I again say should be done in light of looking at the profitability of the business, and really against that backdrop, what is the remuneration that is appropriate for the business owners or directors in the business, and then assuming that on what's set, the business remains profitable. How is that taken? Is it taken as a part wage? Is it taken in some other form? But it's actually not just blindly incurring all of these private or personal expenses when it basically can't be afforded by the company.
Yeah. So some great advice there. And look, when I introduced today's topic, I did say that Bruce was all about helping you turn around your business and giving some great advice. And that's what we've talked about a lot here. Now, we did mention director penalty notices, and we haven't spoken a lot about those, but the good news is we've already done that. We've got a full episode talking about director penalty notices. So I encourage you to go back and re-listen to that. In the event that you unfortunately do receive one, you'll know exactly what to do. But there's a couple of good pieces of advice, or quite a lot of good, really great advice here, is actually understanding your cash flow, understanding your obligations, identifying your costs, identifying your processes, and how we can improve the cash cycle so that we can avoid getting ourselves into a situation where we do have a tax debt problem.
Absolutely, Paul. And I think whilst I know some of the sales and business development people out there would say nothing ever happens in business until the sale is made, whilst that is very, very true, it is also true to say that the sale means nothing if the business is not profitable and or the sale can't be collected. So I think all of those things should be looked at in combination together. And look, it is tough being in SME land. We know that. We see it firsthand with some of the people that we talk to. But a strong finance and administration part of the business is really important to try and give the business the best possible chance that it can of sustaining itself into the future. And in that finance and admin function, what I'm really talking about is both internally, but who you utilize externally as part of that.
Yeah, absolutely. So once again, a lot of great content, a lot of great information to help you, not just if you're in a situation where you've got a mounting tax debt or you've got an issue with tax or collection, but also prevention. We want you to avoid being in this situation. So if you take on board the steps of understanding your costs, understanding your cash flow, planning, working with your advisors, then you'll be well placed to avoid the situation of a tax debt and a director penalty notice. As always, we have a lot of links to resources, some of Bruce's past episodes, which have been really informative and useful. We're going to share the links to those episodes. I encourage you to go back and listen to those again. And also links to some helpful tips that Bruce has already shared with us in the past, but still very valid and practical tools for us to use today. So Bruce, as always, we appreciate your time and thank you for coming back on to the Business Behind Your Business podcast.
My pleasure, Paul, and all I can do is echo your comments. And really, it is about trying to help SME owners with, resources. We want to sort of help businesses on the way through. And part of that does sometimes mean that, seeking some help early rather than thinking that you can do it all yourself is important. Always be prepared to stick your hand up and get some help, because that's what we're here to help SMEs with.
Right. Thanks, Bruce.
Thanks, Paul.
That's a wrap for this episode of The Business Behind Your Business. We hope you found today's discussion insightful and valuable for your business journey. Before we go, don't forget to subscribe to our podcast on your favourite platform. Share it with fellow business owners who could benefit, and send in your burning questions, because we love hearing from you. Missed any of our previous episodes or looking for additional resources to help grow your business? Head over to our website at thebusinessbehindyourbusiness.com. There you'll find our full archive of past episodes, along with show notes, transcripts, and links to valuable resources mentioned in each episode. Your journey to business success continues at thebusinessbehindyourbusiness.com. Until next time, stay inspired, stay informed, and keep building the business of your dreams.